Wars have shaped the course of history in countless ways, but one of their most lasting effects has been on the global economy. Conflict not only devastates nations, but it also drives markets, reshapes industries, and alters global financial dynamics. From World War II to the Gulf War, and more recently the conflict in Ukraine, we've seen how wars can dramatically influence financial markets. In this video, we'll explore how global conflicts impact economies, affecting everything from stock markets to commodity prices. This is not just about destruction. Wars also create opportunities for growth and innovation in unexpected ways. World War II, one of the most significant conflicts in human history, also had profound economic consequences. As nations mobilized for war, economies were transformed. Industries shifted from consumer goods to war production, leading to rapid industrialization, especially in the United States. The need for military equipment created massive demand for steel, oil, and machinery, driving up production and fueling economic growth. However, the war also came with heavy financial burdens. Europe, particularly Germany and Britain, saw widespread destruction, and their economies were in ruins by the war's end. The Bretton Woods Agreement, established in 1944, laid the foundation for the post-war global financial system, stabilizing currencies and establishing the US dollar as the world's reserve currency. This helped the US emerge as an economic superpower while European nations relied on US aid for reconstruction through the Marshall Plan. In essence, World War II reshaped global financial markets and led to the creation of the modern financial system we know today. Fast forward to 1990. The Gulf War presented another key moment in understanding the relationship between conflict and financial markets. When Iraq invaded Kuwait, the world was thrust into an energy crisis. Kuwait and Iraq were major oil producers, and their involvement in the conflict caused oil prices to spike dramatically, creating panic in global markets. As oil prices surged, stock markets around the world experienced heightened volatility. Companies dependent on energy saw rising costs, while oil-producing countries saw massive increases in revenue. Investors shifted their focus to safer assets like gold and government bonds, leading to fluctuations in commodity prices. Yet, the war also demonstrated resilience in financial systems. Once the conflict ended, oil prices stabilized, and markets rebounded. The Gulf War highlighted how conflicts, particularly in resource-rich regions, can create economic instability, but also how markets can recover quickly after a conflict ends. The lesson? Wars might create immediate market volatility, but long-term market resilience often prevails. Most recently, the conflict in Ukraine has further demonstrated how interconnected financial markets are with geopolitical events. The war between Russia and Ukraine, starting in 2014 and escalating in 2022, had immediate impacts on global markets. Sanctions on Russia, one of the world's largest producers of oil and gas, caused energy prices to soar. Europe, heavily reliant on Russian energy, faced an energy crisis, driving inflation and pushing industries to scramble for alternative sources of fuel. The war also impacted global food markets, as both Russia and Ukraine are major exporters of wheat and other agricultural products. The disruption of exports led to food shortages in various parts of the world, increasing food prices globally and triggering inflation in developing economies. Investors, once again, turned to safe haven assets, such as gold, while stocks in sectors like energy and defense surged due to increased demand. This conflict has underscored how localized wars can have far-reaching impacts on global financial markets. The ripple effect from sanctions, trade disruptions, and commodity shortages can destabilize economies far beyond the borders of the conflict. But war doesn't only bring economic destruction. It also often drives innovation. Many of the technologies we use today, such as the internet and GPS, were originally developed for military use. During World War II, industries innovated to meet wartime needs, leading to breakthroughs in aviation, communications, and manufacturing. The Gulf War saw the first use of precision-guided weapons, which pushed defense technology into new territories, impacting industries far beyond the battlefield. Similarly, the modern conflict in Ukraine has driven innovation in cyber warfare and energy diversification, as countries look to reduce their dependence on fossil fuels due to energy supply disruptions. New investments in renewable energy are accelerating. Conflicts push economies and industries to adapt, innovate, and ultimately grow, even in the face of devastation. The economics of war are complex. While conflicts cause immediate market volatility, they also drive economic transformations, spur innovation, and often lead to periods of rapid recovery and growth. The financial impacts of war ripple across the world, affecting industries, commodities, and national economies in ways that can be both destructive and constructive. Understanding this relationship between conflict and markets helps us see how intertwined global events are with the economy and why war has such lasting economic consequences. If you enjoyed this deep dive into the economics of war, don't forget to like, subscribe, and hit the notification bell for more insights into global markets, history, and international relations. Let us know in the comment, how do you think future conflicts might shape the global economy? Thanks for watching, and we'll see you in the next video.